A 77% crash does not begin with companies dying. It begins when investors confuse the elevator with the building. I have watched this mistake cost people entire decades. They think they own productive assets. They think they are participating in American business. In many cases, what they actually own is a ride powered by crowd psychology, multiple expansion, passive inflows, and the comforting slogan that time in the market cures everything. That slogan has made more people lazy than rich. You need to understand something that most of Wall Street has every incentive to hide from you. Price is not value, price is not earnings, price is not proof, price is a vote wrapped around a business. And when that vote gets too enthusiastic, it stops behaving like ownership and starts behaving like elevation. That is what I want you to see. The stock market is not one machine. It is two machines sitting on top of each other. The first machine is the business machine. That is the world of earnings, margins, cash flow, balance sheets, management incentives, and whether a company can keep selling useful products 10 years from now. The second machine is the multiple machine. That is the elevator. That is the part driven by how much investors are willing to pay for each dollar of those earnings. Most people spend their lives staring at the first machine while their financial future is being dominated by the second one. That is why a severe crash can happen without the economy looking like the end of civilization. Earnings do not have to evaporate for wealth to get cut in half. Multiples only have to fall back toward earth. The elevator only has to stop pretending that the penthouse is normal. I have seen generations get seduced by nominal charts. The line goes up, the television anchor smiles, the advisor tells you to stay the course. The mutual fund company mails you a glossy statement. And nobody stops to ask the only question that matters. Up in what? Up after what? Up after inflation. Taxes, fees, bad timing, and the years you do not get back. The nominal chart is one of the most dangerous sales tools ever invented because it flatters your hope while insulting your intelligence. You do not eat nominal returns. You do not retire on nominal returns. You do not pay for dignity with nominal returns. Purchasing power is the only scoreboard that matters, and the inflation mirror is much less kind than the sales pitch. If you bought broad equities at the wrong time in the past, there were stretches when you could wait not 1 year, not 3 years, but 10, 20, even 25 years and still feel like a fool. There were periods when buy and hold was not a path to confidence. It was a long lesson in how expensive blind faith can become. There were periods when the market gave you movement without progress, noise without payoff, and time without reward. That is what the nominal crowd never wants to discuss. They do not want to discuss that there were real stretches in history when inflation-adjusted stock returns went nowhere for an uncomfortably long time. They do not want to discuss that a market can be flat in real terms while companies still earn money. They do not want to discuss that you can be right about capitalism and wrong about your entry point. They do not want to discuss that patience is not the same thing as passivity. So let me say it clearly. The market can be a magnificent wealth engine. It can also be a brutal holding tank for people who bought the elevator at the wrong floor. The average investor thinks earnings drive price. That sounds reasonable. A business earns more. The stock should be worth more. A business earns less. The stock should be worth less. Simple, clean, intuitive. It is also incomplete to the point of being dangerous. Price is earnings multiplied by the multiple. That last part changes everything. If a business earns $5 and the market pays 10 times earnings, you get one price. If that same business earns $5 and the market pays 20 times earnings, you get a much higher price without any miracle in the business itself. The company did not become twice as good. The crowd merely became twice as generous. That generosity is where fortunes get overestimated. I call this the multiple elevator. It is the distance between what a business produces and what the crowd is willing to imagine about that production. In a bull phase, people think the elevator is proof that the building has grown taller. Often it has not. The elevator simply moved faster than the foundation. This is why so many investors become accidental speculators. While insisting they are conservative, they buy index funds, they repeat the approved slogans, they feel sophisticated because they are not chasing penny stocks. But if they never ask what multiple they are paying for the market, then they are still making a valuation bet. They are still stepping into the elevator. They are just doing it with better branding. That is the first trap. The second trap is the nominal hallucination. When you look at the market over very long periods, Nominal prices can make the rise look inevitable, smooth, and benevolent. Then you adjust for inflation, and history becomes far less flattering. Much of what looked like permanent upward progress turns out to be a choppier, more humiliating path. Years compress, decades flatten. Triumph becomes survival. The miracle shrinks. That is not pessimism, that is arithmetic. And arithmetic is one of the few things in finance that does not care about your feelings. Now let me give you the mechanism most people ignore. In secular bear markets, the real damage often does not come because earnings collapse. It comes because the multiple compresses, businesses can keep operating, earnings can even keep growing. But if investors stop paying a fantasy price for those earnings, the stock can still go nowhere or go down hard. You can be holding a functioning business inside a shrinking elevator. That is a miserable place to discover the difference between value and price. You have to understand how psychologically destructive that is. When a person buys a broad index fund at an aggressive valuation, he is not just buying exposure to earnings. He is buying an emotional contract with the future. He is buying the promise that routine behavior will be rewarded. He is buying relief from decision making. He is buying a formula. He is buying permission not to think. So when that formula stops working, the damage is larger than the percentage loss. His identity gets hit, his confidence gets hit, his patience gets hit, and then he becomes vulnerable to the most expensive behavior in markets. Buying faith near the top and buying fear near the bottom. You see it every cycle. People say they are long-term investors when prices are rising. Then the multiple compresses for long enough, and suddenly they discover they were tourists. I have never been paid for tourism. I have been paid for discipline. That is why I want you to stop worshiping the phrase long-term and start examining the structure underneath your returns. If you buy at a rich enough multiple, time is not automatically your friend. Time can become a bill collector. Time can become a penalty box. Time can become a silent tax on overpayment. If broad market valuations merely revert toward a more ordinary modern average, the drawdown can be painful. If they revert toward a longer historical norm, it can be far worse. If they revert toward old secular bear market trough valuations, the numbers stop sounding like corrections and start sounding like air pockets. A decline of 32% is not a fantasy. A decline of more than 50% is not unthinkable. In severe historical conditions, the math can point towards 70+%. People hear a number like that and think it must be theatrical. What is theatrical is the confidence with which they assume the elevator cables are guaranteed. They are not. Now, let us move to the mechanism that has helped keep the elevator aloft: passive flows. This is where modern investing becomes especially deceptive. The average worker is told to contribute every month to index funds, usually through a retirement plan. He is not analyzing businesses. He is not comparing valuations. He is not asking whether the market multiple makes sense. He is following a route. Money comes out of the paycheck. Money goes into the fund. The fund buys. That is not price discovery. That is a conveyor belt when millions of people do this at the same time. And retirees are still drawing out less than workers are putting in. The market gets a steady tailwind. More dollars come in than go out. The elevator keeps rising. The crowd mistakes the inflow for proof of intrinsic value. It is one of the most profitable misunderstandings of the modern era. But tailwinds are not laws of nature. They are conditions, and conditions change, demographics change, labor markets change, retirement patterns change, job creation changes, technology changes, who gets a paycheck and who does not. A recession changes what households are able to contribute. A weak labor market changes the direction of savings. A wave of retirements changes the direction of withdrawals. The same passive system that acts like an automatic bid on the way up can become an automatic source of pressure when inflows slow and outflows rise. That is the retirement reversal. I want you to remember that phrase. The retirement reversal is what happens when the passive bid stops behaving like a permanent buyer and starts behaving like a shrinking support beam. If one worker is buying while 3 retirees are selling, you do not need a PhD to understand the direction of pressure. If labor conditions soften and fewer paychecks are feeding the funds, you do not need a genius to see how the math changes. If unemployment rises into a range where contributions dry up while withdrawals continue, the elevator no longer has the same upward force, then the multiple matters more than the slogan, then valuation matters more than habit, then liquidity matters more than optimism. This is where so many investors get trapped by social gravity. Their neighbors are in index funds, their advisor is in index funds. Their company plan defaults them into index funds. Personal finance celebrities tell them to keep buying. The culture has turned one tactic into a moral virtue. It is no longer presented as one possible tool. It is presented as the responsible identity of a good adult. That kind of moral packaging is dangerous. Any strategy that cannot survive examination usually survives by becoming a religion. I am not attacking broad market ownership. I have recommended simple, broad exposure for many people over the years because simple can beat foolish. But simple is not the same thing as mindless. And broad diversification is not a hall pass that exempts you from valuation, timing, liquidity, and cycle risk. If you do not know what multiple you are paying, if you do not know what part passive flows play in market support, if you do not know what a decade of real stagnation looks like, then you are not investing with simplicity. You are investing with borrowed conviction. Borrowed conviction is fragile. The market punishes fragility. Now, let me tell you where most people go wrong emotionally. When they hear a severe downside scenario, they immediately imagine that the response must be either panic or prophecy. Either sell everything and hide or ignore everything and keep repeating the same line about dollar cost averaging. That binary thinking is childish. Real capital allocation is more mature than that. When I see an elevator rising because people are willing to pay more and more for the same dollar of earnings, I do not need to scream. I do not need to predict the exact day the doors jam. I need to understand what floor I am on, how crowded the car is, what the cables are made of, and whether I would rather be holding optionality outside the car than confidence inside it. That is where dry powder comes in. Dry powder is not fear. Dry powder is refusal power. Dry powder is the ability to watch opportunities become bargains without being forced to liquidate something else at the wrong time. Dry powder is the right to say no when the crowd is euphoric, and yes when the crowd is nauseated. Dry powder is what separates an owner from a hostage. I have held plenty of cash and short-term treasury bills when I believe the opportunity set did not justify full aggression. People mock that behavior in strong markets because they think cash is laziness. What they really hate is restraint. Restraint makes impulsive people uncomfortable because it exposes the fact that not every dollar must be sent into battle the moment it arrives. Sometimes the highest return action is refusing a bad setup. That is especially true when valuations are rich and the passive machine has convinced people that mechanical buying is the same thing as intelligent buying. Short-term treasury bills may look boring to the thrill-seeking mind, but boring is often exactly what protection feels like before it becomes respectable. The man fully invested at a foolish multiple feels smart until the drawdown begins. The man holding liquidity feels foolish until the drawdown creates choice. Then the roles reverse. I would rather look conservative before a repricing than clever during one. The crowd prefers excitement. I prefer terms. Now, none of this means that every stock is doomed or that every business is fake. It means you must separate the building from the elevator. Some businesses will continue compounding value. Some managers will continue allocating capital intelligently. Some balance sheets will remain strong. Some cash flows will remain durable. But if the market as a whole is priced on generous multiples, then even good businesses can get dragged down when the elevator descends. In that environment, your job is not to recite slogans. Your job is to know what you own, what you paid, what could hurt the multiple, and whether you have enough dry powder and emotional control to survive the descent. That is a much harder job than simply clicking buy every month and calling yourself disciplined. But difficult is not the same thing as optional. If you want real control, you must do the adult work. Look at what most people are actually optimizing for. They want the feeling of participation. They want the reassurance of movement. They want a clean answer they can repeat at dinner. They want to believe that because the market has gone up for them recently, the underlying mechanism must be healthy. They do not want to study valuations because valuations interrupt comfort. They do not want to study demographics because demographics ruin narratives. They do not want to study labor market deterioration because labor weakness makes automatic strategies look less automatic. They do not want to study multiple compression because multiple compression reminds them that a market can hurt them without the businesses beneath it disappearing. Comfort is expensive, reality is cheaper up front and cheaper in the end. You have to choose which bill you prefer. I also want you to notice how passive systems alter your psychology. When money leaves your paycheck automatically and enters the market automatically, it feels like productivity. It feels like adult behavior. It feels like an operating system. But if you never interrupt that loop with valuation, judgment, liquidity planning, and scenario analysis, automation can turn from a wealth tool into a thought substitute. That is the passive trance. The passive trance is seductive because it feels efficient. It is also dangerous because it trains you to stop asking what happens when the flow changes. If enough people lose jobs, contributions slow. If enough older investors draw down savings, selling rises. If AI or recession changes the labor base, new buying weakens. If sentiment breaks while multiples are rich, compression accelerates. If compression accelerates, the people who said they were long-term suddenly discover their time horizon was emotional, not financial. That is when the elevator becomes educational. I do not enjoy that lesson for people, but I have seen it too many times to pretend it does not happen. Investors who thought they were buying safety discover they were buying sequence risk. Investors who thought they were buying permanent growth discover they were buying optimistic pricing. Investors who thought they were diversified discover they were concentrated in the same narrative, the same route, the same passive bid, the same retirement machinery, the same collective assumption that someone else will always be there to buy higher. Someone else is not a strategy. Arithmetic is a strategy. Liquidity is a strategy. Valuation discipline is a strategy. Emotional control is a strategy, and patience is only a strategy when it is attached to judgment. If I were speaking to an ordinary worker with a 401k, I would tell him not to become theatrical, but not to become asleep either. Know what portion of your life is exposed to broad market multiples. Know what would happen to your plans if the market fell by a third, by half, or worse. Know whether you have cash reserves outside the market. Know whether you are forced to sell during stress. Know whether your household can handle job instability at the same time your portfolio is falling. Know whether you are buying because you have done the math or because the cultural script told you that refusing to ask questions is wisdom. Most people do not lose because they are stupid. They lose because they outsource the most important decisions to slogans. That is the real worker trap. The worker trap is not merely depending on a paycheck. It is depending on a paycheck while pretending market exposure automatically converts that paycheck into sovereignty. It does not. Ownership without price discipline can still leave you fragile. Equity without liquidity can still leave you trapped. Diversification without valuation awareness can still leave you overexposed to a broad repricing. I want you to be more serious than that. I want you to understand the distinction between a compounding machine and a crowded elevator. A compounding machine is a high-quality business bought on reasonable terms and held with rational patience. A crowded elevator is what happens when masses of capital pile into assets because they went up, because the flows are easy, because the plan defaults them there, because the pitch is emotionally comforting, and because nobody wants to be the person standing in the lobby while others float upward. There is social pressure in every bubble. The bubble does not even need to feel like a bubble anymore. It only needs to feel normal. Normal is where most financial mistakes hide. The reason severe market declines feel impossible right before they happen is that investors stop examining mechanism and start examining mood. If the mood is calm, they assume the mechanism is healthy. If the statement is green, they assume the structure is sound. If the financial planner says stay the course, they assume the course has been measured. That is not analysis. That is sedation. I have built wealth by doing the opposite. I have tried to look where enthusiasm least wants to look. Incentives. Terms, price, liquidity. Counterparty strength, optionality. The distance between a good business and a good investment. The distance between movement and progress. The distance between being invested and being prepared. Prepared is a better feeling than fully invested. Prepared means you can survive error. Prepared means you can exploit panic. Prepared means you do not need a slogan because you have a system. That system does not have to be complicated. In fact, complexity often exists to hide weakness. but your system must answer the questions that slogans avoid. What are you paying? What are you assuming? What if the multiple compresses? What if passive inflows reverse? What if your job gets weaker at the same time your portfolio does? What part of your balance sheet is dry powder? What part of your portfolio is exposed to the same macro mechanism? What would you be delighted to buy lower? What would you be embarrassed to own if price stopped flattering you? If you cannot answer those questions, you are not holding the elevator. The elevator is holding you. That is the hard truth. Now let me give you the freedom side of this. Because I am not interested in fear without utility, the purpose of seeing risk clearly is not paralysis. It is positioning. You can shorten the distance between you and intelligent action by building liquidity before everyone wants it, by lowering leverage before it humiliates you, by refusing to mistake passive flow support for permanent value, by demanding a margin of safety, by treating cash and short-term treasury bills as strategic assets instead of dead money, and by remembering that the best opportunities often appear only after the elevator has dropped far enough to make the crowd swear off the building entirely. That is when serious money gets made. Not by chanting through overvaluation, by preparing through it. I have never needed every month to be exciting. I have needed my capital to remain intelligent. That means there are times when the most rational posture is not heroic participation. It is selective patience. It is refusing to pay a euphoric price for average future returns. It is refusing to let the culture shame you for holding liquidity. It is refusing to let a retirement plan default become your worldview. It is refusing to let a decade of easy gains erase a century of market history. History matters because it reminds you that the elevator has dropped before. History matters because it reminds you that real returns can disappear for long stretches. History matters because it reminds you that the multiple is not a law, it is a mood. And moods revert if you are honest. That is what makes the present so dangerous for complacent investors. They are not merely betting on American business. They are betting that generous pricing, passive support, labor stability, retirement flows, and public faith will all cooperate long enough for them to leave the car before the descent turns violent. That is too many assumptions for me. I would rather own strength than assume benevolence. So here is the test. If the market fell by half and stayed wounded for years, would your financial life still be under your control? Or would you discover that your confidence was borrowed from an elevator you never understood? If passive inflows weakened, if retirees kept selling, if labor markets softened, if multiples compressed, would you have dry powder, patience, and emotional room to act? Or would you become one more person pressing buttons inside a falling box? That answer matters more than your opinion on whether the next decline is 32%, 52%, 72%, or 77%. The exact number is not the point. The point is whether you are building wealth on a foundation or riding confidence in a shaft. Most people will keep choosing the ride because the ride feels rich. A smaller group will step out. Study the building, hold some cash, hold some T-bills, demand better terms, and wait for arithmetic to do what arithmetic always does. You have to decide which group you belong to because when the doors finally open on a lower floor, one group will call it bad luck, the other group will call it the first honest price they have seen in years.